moments. With every rule, there's always the exception. There is actually an exception to the use of the in-the-money option for stock replacement. There is a time, a specific technical event, where we're going to be better off choosing the at-the-money option, the 50 delta option, instead of the in-the-money option, the 85 delta option. And this is it. When we're expecting a large, volatile movement in the stock, and there's only two technical events that fit that description. On the upside, a technical breakout. On the downside, a technical breakdown. Most breakouts and breakdowns are shorter term movements, 3 to 8 days. Not really a long-term investor's cup of tea, more of a swing trader. 3 to 8 days. But in those 3 to 8 days, we can see a 10 to 15% movement in the stock. Why then won't we just use the in the money? Couple reasons. Number one, there's a thing called a false breakout or a false breakdown, where the stock technically violates a resistance or a support, makes it look like it's now going to be a breakout or breakdown, but doesn't follow through, turns and goes back into its trading range. And when it happens, normally, if it's a false breakout to the upside, the stock turns and goes straight down to retest the lows of the trading range. Instead of buying the call and getting that 10 to 15% up movement, you might turn around and find yourself in a stock that's having a rapid 10 to 15% downward movement, and here you are in the call. So that happens on occasion. There's also the potential for a false breakdown. The stock technically violates a support, but instead of following through, it rushes right back over the support and then goes up to test the upper end of the range, the resistance level. If you bought a put on the technical breakdown and it's a false breakdown and the stock turns and runs the other way, you might see a 10 to 15% gain in the next 3 to 8 days. And you, in that long put, are on the wrong side of the equation. So when we're looking at breakouts and breakdowns, because of the volatile nature, there's more risk. And with more risk, we want less risk. How? We're going to use a cheaper dollar option. We're not going to have as much money up. Our 50 delta at the money call or put will be less expensive than our 85 delta in the money call or put. One of the problems we had with the at the money option in most normal movements up or down was we said that the stock had to outperform the extrinsic value. And that's very difficult for a stock to do under normal situations. But when we're talking about a breakout or breakdown, we're not talking about a normal movement. We are automatically talking about a stock that is going to outperform and do it quickly. So in a situation where the stock is outperforming, I'm not so concerned about the amount of extrinsic value. Am I concerned? Yes. As concerned as a normal stock movement? No way. Breakouts and breakdowns are rapid, big movements. The stock naturally outperforms. This way, I'm a lot more comfortable with using the at-the-money option because I'm not quite as afraid of that extrinsic value and the stock's ability to outperform it. I'm expecting it to outperform. The at-the-money option gives us a lot of vega. We said that in normal stock movements, we don't want that. The stock doesn't have exposure to implied volatility. Why would we want to have an option that has the most exposure to movements of implied volatility? We wouldn't under normal situations. This is not a normal situation. This is a technical event, either breakout or breakdown. Here, because the movement is so aggressive and so fast, our positive, heavier vega that we get in the at-the-money option, which we tried to avoid by going in the money, here helps us. The positive vega, the bigger vega of the at-the-money, plays now into our advantage. Why? Because this movement here is extremely volatile. And more often than not, the volatility of this option will increase on the breakout because of the size of the movement and the speed of the movement. So suddenly, vega becomes more of an ally than a hindrance. In a normal stock movement, vega is normally a hindrance. Here, under this situation, it's not. It can work to our advantage. Much more frequently in calls, but remember when we talked about puts, we said that vega normally works in our favor. So here, it's more along the side of the breakout that the positive vega now really helps us more often. Finally, the speed of the movement. We said that breakouts can move the stock 10 to 15%. That's a big volatile movement. But more importantly, it can do it in 3 to 8 days. That's a fast, very volatile movement. The beauty of that is the speed of the movement helps to alleviate my theta risk. Remember, I said I didn't want to use the at-the-money option under normal conditions because there's a ton of extrinsic value there. And that extrinsic value is going to decay over time. And I don't want to have all of that decay in case the stock takes a little longer to move than I was expecting. I wanted to get away from that decay. I went in the money. But in this event here, this specific technical breakout and technical breakdown, I'm looking at a movement that's not going to be months. It's going to be 3 to 8 days. It's a quick movement. It's so fast that theta is barely going to have the time to attack your option. Suddenly, in this situation, that of a technical breakout or a technical breakdown, I am not afraid of vega. I'm actually wanting it. I'm not nearly as afraid as of theta because it's going to be so quick, theta's not going to have the time to hurt me bad. In this situation and this specific situation only, we will opt for the at-the-money option, the 50 delta option. Every other time, we're going 85 deltas. But right here, under this condition and this condition only, technical breakout, technical breakdown, you go with the 50 delta option. Let's talk about our keys to success with this strategy. I mean, what's really the nuts and bolts of me being profitable consistently with this strategy? Number one, it's a stock trade. Remember I said always go back to it's a stock trade. Key number one is solid technical and fundamental analysis of the stock. We need to know the direction. We need to find a stock that's going up or going down. I don't care which one you find. If it's going up, we buy the call. If it's going down, we buy the put. They're both going to work the same way mechanically in just different directions. But the fact is, this is a trade of stock movement. We need to know where the stock is going. So technical and fundamental analysis become extremely important with the success of this trade. Call the wrong direction, you lose. That's it. We need to choose the right option for the job. We know that most of the time, under most situations, we need to find the 85 delta call. We're going in the money, 85 deltas. And we're trying to match the length of the expected movement, time-wise, to our days to expiration. We don't want to buy too much time. We don't want to buy too little. Do we have to buy the exact time? No. Just keep it reasonable. Don't say, hey, it's a 2-month movement, 12-month option, that's what I'm buying. No. 2-month movement, 3-month option, 4-month option, fine. Just don't get ridiculous and buy way too much time. We've got to understand, and you're going to be seeing this in a few minutes, the roll strategy. The success of this strategy on a consistent basis of profitability and limited risk requires you to roll, roll, roll. I want you to walk down the street during the day at lunch, talking to yourself, saying, roll, roll, roll. That's what I want you to do. No more white bread. I want you to eat rolls. You've got to roll this position consistently. Make sure you know that when your trend is broken, if we're seeing a stock that's trading up and we're in our long call, the moment that that trend ends, it's time to do something. Don't sit there and hold the call as the trend ends and the stock goes against you. You're going to lose the money you just made. We are in the call on the way up. We're in the put on the way down. When that directional trend ends, it's time to either close out or morph the position. Be patient. The fact is that rolling not only locks in our profits, it also removes our risk. With less risk, we can be more patient, more calm, and let the stock do the work. Let the trend play out. We don't have to sit there and get all nervous. It's still in the trend, but the trend might end tomorrow. What do we do? Relax. You've already pulled out a good portion of your profits if you've been rolling. You already have limited your risk and have kept it limited as the stock went up. Stay patient. Stay patient. Now that we have the position on, we have to talk about trading it. How are we going to manage it? What adjustments are we going to make? That's what we have to do next. We're going to take a look at the call first. What is rolling? Rolling is moving the same position to different months or different strikes. Remember, when we initially jumped into the position, we bought a specific strike in a specific month. But as the stock starts to move, that specific strike, that specific month might not be optimal any longer. More so with the strike. As the stock goes up, the strike we originally bought that was 85 deltas is not going to be 85 deltas anymore. The delta is going to increase as the stock trades up. What's going to happen? As that stock price increases, you've got profit. That profit is still in the market. We need to get that profit out. I'm going to show you how to do that. That's rolling. Morphing is different. We're not trying to maintain the same position when we're morphing. Quite the opposite. In morphing, we're trying to actually change the entire position. We want to say to ourselves, hey, things were going good, but now the stock is moving in the other direction. I want to take the position I'm in, be able to lock it down, lock in my profits, and spin myself into the other direction to start making money the other way. That is morphing. Being able to do that with one simple, quick trade. And finally, we could always just close it out. You got a profit, you had a good run, you're not sure anymore. When in doubt, close out. Just get out of the trade. Take your profits, take a deep breath, go get yourself something to eat, relax, and come back and now revisit the situation. You can't get hurt if you're not in there. And if you closed out with profit, you can take your time and reevaluate the situation. So there's never a problem closing out a profit. Closing out one too soon can be a problem. That missed opportunity cost is money that you actually need to cover losses that you might have in the future. And you will have losses. That's just part of the game. So what do we do if the stock is trading in our direction? First, potential rolls. We're going to roll long calls up, and we're going to roll long puts down. Let's talk about rolling the long calls up first. Whatever strike we own, as the stock trades up, we're going to wind up building profit in our strike. If we're in the 50 strike, the stock is trading up, our 50 strike becomes more valuable. The delta becomes larger. What we're going to be able to do is say to ourselves, let's sell out the 50 strike calls. And when we sell those out, let's then buy the 55 strike calls. When we do that, we know that the 50 strike has to be more expensive, more valuable than the 55 strike. We're going to sell an option that's more expensive than the next option up that we're going to buy. What we're going to wind up doing is bringing in a credit. We're selling at a higher price, buying at a lower price. When we do that, sell the 50, buy the 55, what we're doing is the credit that we're bringing in is part of us locking in our profits. We're moving from the more expensive option to the lesser expensive option. By doing that, we've locked in our profits, but we've also limited our risk. Why? Because I am now in the 55 strike. The 55 strike is less expensive than the 50 strike. And because of that, I have less money in. Thus, I have less money at risk. So I'm locking in my profit and limiting my risk. For the puts, works the same thing the other way around. I'm going to be in my 50 strike puts. As the stock trades down, the 50 strike becomes more valuable. It becomes more expensive. I now have profit in it. As the stock continues down, the delta of my 50 strike puts will increase. So I say to myself, you know what? I've got some nice profit in here. I've got a higher delta now in these puts. I'm going to roll them down from the 50 strike to the 45 strike. When I do that, by rolling, I am selling my long puts, the ones at the higher strike, the ones that have more value than the 45 strike I'm about to buy. When I sell something more expensive and buy something less expensive, that's going to create a credit, money coming into me. That credit is part of my profit that I'm now taking out of the market, locking down, and making sure that the market can't get back at it. I've also limited my risk. With the 50 strike being a lot more expensive, I would have more money up in the market at risk in the 50 strike. But now, I've rolled down to the 45 strike, less expensive, less money in the game, less risk. Potential morphs. Well, if the stock's going in my direction, why the heck would I want to change something that's working? We don't morph or change the position if it's working. What's that saying? Don't fix what ain't broke. This isn't broken. This strategy is working exactly the way we want it to. We don't want to change it, and we don't want to close it. The only thing we want to do is roll it. Continue the strategy going. The stock's moving in the right direction. We continue the strategy. So let's take a look at this roll. Here's a stock replacement call. We just bought the June 60s. The stock might have been trading, say, at 65. As the stock trades from 65 to 70, we sell out our 60s and we buy the 65s. We roll up to the 65s. That trade there, selling the 60s, buying the 65s, will give us a credit. That credit coming into our account is us locking down part of our profit. The stock continues up. Now the stock is running from 70 to 75. What do? We roll again. And we'll continue to roll. As long as the stock goes up, we will continue to roll that call up. As far up as it goes, we're going to roll, roll, roll. Each time locking in profit, each time limiting our loss. Also works for the puts. In the money put right here. What delta? About 85, right? Okay. In the money put right here. The stock is trading, say, around 70. Stock trades from 70 down to 65. What do we want to do? Roll from the 75s down to the 70s. The 75 strike is going to contain some profits that we have. And it's going to also be more expensive than the 70 strike. By selling out our 75s, the more expensive option, and buying the 70s, the lesser expensive option, we are going to wind up bringing up a credit. We've got a credit coming into us. Now that we have that credit coming in, that's part of our profits from that first stock movement. So we've locked in some profits, but we've also moved to a lower dollar figure option. We've removed risk, because remember, we can only lose the value of that option. If it has less value, we have less to lose. Stock keeps moving. What do? We're going to roll again. We're going to go from the 70 strike down to the 65 strike. Again, locking in profits because we're bringing in a credit by selling the more expensive option and buying the lesser expensive option. And we've also lowered the amount of money we have in, which is the money we have at risk. The stock goes down again. What do? We roll again. We roll, roll, roll. Follow that stock to zero if you have to on the way down. On the way up, follow it to infinity. It doesn't matter. You're constantly locking in profits, constantly limiting your risk. What if the stock trades against us? That happens. Sometimes we pick a direction and we're wrong. Well, we've got some potential rolls to look at. Or do we? If the stock trades against us, then whatever trend we thought we were in is wrong. Don't roll a losing position. If I'm losing money, I don't want to continue losing money. Rolling is a continuation strategy. We don't roll positions that are losing money because I don't want to continue losing money. Rolling a trade that is going against you is bad every time. We don't roll losing positions. So there are no rolls. But what is there? A morph. We are in the wrong trade. The trend is against us. We have misread the movement of the stock, and the position we put on is now wrong. What do we need to do? Change it. What can we do? Well, if we're in the long call position, we can actually, using synthetics, turn that long call into a synthetic long put. That's pretty good, isn't it? Stock's trading up, or we thought it was going to trade up. We buy a call, stock starts to trade down. Turn that call into a put, now I'm making money on the way down. I like that. And if we're long the put, we can turn that put into a synthetic long call. I think the stock is going to go down, I buy a put. The stock instead starts to trade up. I turn my long put into a long synthetic call. Now I'm in the right direction making money. I can do this with one trade. And don't forget, you can always, always close it out if you're wrong. You could just sell out your long call if you're wrong, or sell out your long put if you're wrong. But let's take a look at this morph. Here I am in my stock replacement call. I obviously think the stock is going up, and I'm wrong. The stock starts trading down instead. What can I do? I can sell 100 shares against my call. What have I done? I've created a synthetic long put. I am now long the 65 synthetic put. Now with the stock going down, I'm in the right position. With just the addition of the sale of the stock in a one-to-one relationship with the call, I have just created a synthetic long put. What if I'm in a put because I think the stock is going down? But I'm wrong. The stock decides to trade up instead. I buy 100 shares of stock. Why? Because 100 long shares of stock plus one long put equals a long call. Synthetically, I am long the 70 call now with the stock trading up. I took my long put, which needs the stock to go down, and didn't get it. I took that long put and changed it synthetically into a long call. And I did it in one trade, not two. I didn't sell out the put and buy the call. 2 bid-ask spreads, 2 commissions. I did it with one trade. What if the stock stays still? I'm in stock replacement and the stock doesn't move. Well, I have a couple things I can do. Number one, I haven't really been hurt that bad because if I chose the right option, I steered myself clear of heavy theta. So time has gone by. I haven't been hurt that bad. The stock hasn't moved yet. But I still feel there's a potential. So what can I do? I can buy more time. How do I do that? Here I am in a stock replacement call. Roll it out. Roll it out. Sell the call I have, buy the next month call. It will cost me a little money to do. But if this expires at expiration in June, and you come in and this happens all the time. Should I roll that call? I always say, nah, just let it go. Guess what happens? June expires. Here comes July. Guess what happens to that stock on the first day of July? Yep, boom, takes off like a rocket. I've been waiting a month for that movement. The day my option expires, the next day, bango, there's the movement. I can actually roll out. The reason I can do this is because when I chose the 85 delta option, I didn't take on too much decay. I'm not down that much money because there wasn't a heck of a lot of extrinsic value in the option. I have the ability to roll out because I'm not dealing from a standpoint of a big loss already. If I was at the money, different story. I could have a significant loss right here. But I'm not. I'm in the money. So what can I do? I can roll out. And then what do? I can roll out again if I need to. I can continue rolling out, getting myself more time, as long as my losses haven't mounted too big, and as long as I still believe that the chart pattern is going to happen. Well, now that we've done that with the calls, obviously we can do that with the puts. If we feel we need a little more time, we could just simply roll the put out and buy more time. Will it cost us some money? Yes, it will. But the one thing you don't want to do is have that put expire, and then the next day after expiration, boom, the stock goes down. It's something about Murphy's Law. It always hits you when you don't want it to hit you, right? Well, the fact of the matter is that because we're using the in-the-money options, this roll here is not a very expensive roll. So if we haven't lost a lot of money in decay, and the roll isn't going to cost us a lot of money, we have some money to spend or quote-unquote risk to keep rolling these things out to buy time if we need it. So that's about it with the stock replacement strategy. Hopefully, many of you will be using this very easy strategy very soon. And for you stock traders, here's an opportunity for you to use options without really becoming an option trader.
All right, Ron, well, that was great. You just covered stock replacement strategy pretty well. I think it's one of the most easiest possible strategies to understand, one of the most important because it increases your reward while decreasing your risk. Very important. The next thing we're going to cover is covered calls. Now, before you cover covered calls, I want you to go to optionsgps.com and talk to your peers about stock replacement strategy. Very basic strategy, but incredibly powerful. And then take the quiz, pass the quiz, and then I'll see you on the next DVD, which is going to be covered calls.
Okay, let's take a look at Chris's example of an opportunity to use a long stock replacement. And he chose OIH, the Oil Service Holders. It's an ETF. The thing you want to know about this right here is that it's pretty expensive, isn't it? $169.25. It's going to knock you big if you have to start buying a lot of shares of this thing. So what are we going to do? We're going to use the cost efficiency among other attributes and advantages of the stock replacement strategy. We're going to use the cost efficiency here. We're really going to focus on that. Instead of spending $169.25 for the actual underlying security, we're going to instead purchase a stock replacement call here in January of 09, the 145 strike at $35.60. A lot more manageable. The delta is 74. That means the movement of this option will mimic the stocks to 74%. Couple other advantages. After we buy this option, if the stock does trade up, we're going to be able to roll this long call with the stock on a consistent basis, constantly locking in what we've made, limiting our risk, but keeping our position size the same. Can't do that when you use the underlying security. If you're going to lock in profits in the underlying security, you're going to have to decrease the size of your position. So very simple. Why did we choose January? Because when Chris looked at the chart and determined how long he thought the movement would take or last, he teamed that up and equalized it with a month that had the days of expiration that was similar to the length of time he thought the movement was going to take. So very simple. Instead of just buying that stock at $169.25, we go to the month that we think would be most likely to where the movement is going to equalize with our days to expiration. That was determined to be January. And we simply go and find a deep in the money option. In this case, we took a 74 delta, and we are going to now buy that call. And as the stock goes up, we're going to roll right along with it. Chris has found an opportunity to take advantage of an expected downward movement here in American Express. Now, American Express trading at $33. It's a financial. What does that mean? Financial means, in this market environment right now that we're in, that there's some risk here. We want the safety of being able to buy a put to get short. It's sometimes tough to short a stock that's in some significant trouble. Take a look. Just in today, the stock was down over 10%. So what do we have here? We're going to do a stock replacement put strategy. We are going to replace a short stock position because we all know that we might not have enough margin. There could be rules. We might have an account that doesn't let us short stock. We could be with the wrong broker, and they won't let us short stock. There's a lot of barriers to getting short in the market, and short stock is probably the most difficult thing for an investor to do. So what are we going to do? We're going to buy a put. First thing, we need timing. Chris has identified the length of the movement that he's expecting time-wise. We go out to that month. If you think it's going to be a 3-month movement, fine. If we think it's going to be a 5-month movement, fine. But you've got to go out to that month and equalize your expectation of the movement with the days to expiration of your option. Then, once we found the month, we now have to find the strike. Which one of these puts is the right one? And we showed you how all you have to do is go find the right delta. And in this case, we're going to look at the 42.5 strike or the 40 strike. Either one. We said that we were looking for around 80 deltas, maybe a little more. 40 strike is 81 deltas. 42.5 strike is 91 deltas. Either one of those will work for you. Once you buy those puts, what you want to do is start rolling them down as the stock trades down. Stock trades down from 33 down to 30. If we were in the 42.5 puts, we better move ourselves down to the 40 puts. Stock trades down from 30 to 27. If we're in the 40 puts, we're probably going to move down to the 37.5s. Constantly rolling. Why are we rolling? To lock in profits and maintain our position. The beauty is we're also decreasing our risk at the same time. That's the beauty of the stock replacement put, and that's how we would set this trade up.